Hey everyone, ready for a deep dive? Today we're cracking open Benjamin Graham's The Intelligent Investor.
The father of value investing.
The OG, right. And we're focusing on chapter 18 where he compares these 8 pairs of companies.
Fascinating stuff. Really gets you thinking about what makes a business valuable. Not just like, the hype.
Forget the headlines, we're going deep.
Mm-hmm.
So Graham starts with 2 real estate companies, right? Real Estate Investment Trust, REI, versus Realty Equities Corp of New York, REC. Tortoise and the hare situation, kinda.
Yeah, REI was all about those steady dividends. Like going back to 1889, they weren't flashy, just solid, consistent.
But REC, they were on a roll. Racetracks, movie theaters, all kinds of ventures.
The market loved them. Stock price went through the roof. Nobody even seemed to notice REI.
So who won in the end?
You guessed it. REC's growth, it wasn't sustainable. They almost crashed and burned completely. REI, they just kept chugging along, proving that slow and steady can win the race.
A lesson for us all? Don't chase the hype. Look for the substance. Exactly. Next up, Graham compares 2 companies in the industrial gas biz, Air Products
Okay.
and Air Production Co. Now, Air Products was smaller but more profitable. They were growing faster too. So investors were willing to pay a premium for their stock.
Makes sense. Quality often comes at a price.
Right. But Air Production was trading at a discount. They were bigger, more established, just not as profitable. So Graham asked this question. Is that premium for quality always justified?
Tough one. As investors, we have to figure that out, right? Sometimes the market overvalues that hot company and undervalues a solid but boring one.
Spot on. And then pair number 3 throws us into the world of healthcare. American home products, a bunch of drugs, and household stuff,
Okay.
compared to American hospital supply. Both were doing great, strong growth, looked amazing on paper.
A dream scenario.
Yeah, but they were trading at sky-high prices. Like, investors were baking in a ton of goodwill, those intangible hopes and dreams.
So paying extra for the brand name, but in this case, the brand name's a company.
Exactly. And Graham, he's worried, right? Are these expectations too high?
Can the companies live up to the hype, even in a hot industry like healthcare?
Yeah.
Got to be cautious with those valuations.
Absolutely. Then Graham goes for this wild contrast. H&R Block, the
Yeah.
tax people,
Yeah.
they were brand new, exploding in growth, trading at like 100 times their earnings. And then there was Bluebell, the work clothes company.
Okay.
Much older company, steady growth, trading at a reasonable 11 times earnings. H&R Block was the hot stock, the story everyone wanted to be a part of.
But Bluebell offered more tangible value for your money.
Right. Classic case of getting seduced by a good story. Got to remember, growth needs to be backed by something real.
Don't just buy the hype, buy the substance. Sometimes it feels like the market is playing a game we don't understand.
Oh, it definitely has its own logic, and it doesn't always align with common sense. That's why Graham's next comparison is so interesting.
Okay, lay it on me.
He takes International Flavors and Fragrances, IFF,
Really?
relatively small company, right?
IFF, yeah.
Up against this massive giant international harvester. And guess what? IFF was valued higher by the market.
No way. Size doesn't always equal success, I guess.
Exactly. Harvester was huge, but struggling to turn a profit. Their margin was a measly 2.6%.
Oof, not great.
Now, IFF, they were a profit machine, 14.3% margin. Plus, they were growing like crazy.
So even though they were smaller, investors saw their potential, that ability to generate serious returns.
It's a reminder that profitability matters
Oh.
a lot. Now, pair number 6 takes us to a different world. Utilities versus publishing, McGraw-Edison, good old-fashioned equipment,
Okay.
and McGraw-Hill, the book publishing giant. Which one do you think Wall Street was more excited about?
Publishing sounds a bit more glamorous than utility poles.
You got it. McGraw-Hill was trading at a huge premium. Investors were basically betting on their past success, even though their earnings were already starting to slip.
Triumph of hope over experience, right. Ignoring the facts and just clinging to that rosy picture of the past.
Exactly. And meanwhile, McGraw-Edison was chugging along, consistent earnings, reasonable price. But nobody cared.
Classic case of the market getting swept up in a narrative. It's like some investors are still holding on to those once mighty tech companies, hoping for a comeback.
Dangerous game. Okay, ready for pair number 7. This one's a doozy. Conglomerates.
Bring on the complexity.
We've got National General Corps, this sprawling behemoth involved in everything you can imagine. Movie theaters, chicken restaurants, even music publishing.
Wow, talk about spreading yourself thin.
And their financials were a mess. Warrants, debt, convertible bonds, you name it.
So, not the easiest company to understand, I take it.
Not at all. Now, compare that to National Presto Industries. Much smaller, focused mainly on appliances. Simple capital structure, easy to grasp.
Okay, I'm seeing the contrast here. One's a tangled mess, the other's clean and focused.
Right. And despite all its tentacles, National General actually generated less revenue and lower net income than National Presto. Graham really tears apart their valuations, showing how all that complexity can hide a lack of substance.
A good reminder to be cautious of anything we can't easily understand.
Transparency is key. Now the grand finale, pair number 8. Prepare to be baffled.
I'm ready. Hit me.
We've got Whiting Corp. Solid company, consistent earnings, paid a nice dividend. And then there's Wilcox and Gibbs. Small conglomerate, no dividends, and a bunch of random businesses.
Sounds like Wilcox and Gibbs was the market favorite, even though they weren't paying out anything to shareholders.
You know it.
Yeah.
They were trading at a way higher valuation than solid, dependable Whiting Corp. It makes zero sense, right?
That's like choosing a flashy sports car that doesn't even have an engine. Why would the market do that?
This is Graham showing us the pure irrationality of the market. Investors were seduced by the conglomerate structure, totally overlooking the fundamental value offered by Whiting Corp.
So how do we avoid falling for these traps? How do we make sure we're not buying the car with no engine?
That's where Graham's idea of independent thinking comes in. Question everything, look for mispriced opportunities, and be bold enough to invest when everyone else is running scared.
Easier said than done, but I'm starting to get the picture. We need to trust our own analysis, not just follow the crowd. Wow, 8 pairs of companies, and each one just makes you think. Like, really think about what the market's doing.
It's a masterclass in market psychology. Graham shows us how investors get swayed by these stories, these narratives, and sometimes completely miss the point.
So how do we cut through all the noise? How do we apply Graham's wisdom to, actually make smarter decisions?
It starts with a shift in mindset. Investing, it's not about beating the market or timing things perfectly. It's about understanding the true worth of a business. It's intrinsic value. And then being patient, being disciplined, often going against the crowd.
We're like detectives, right? Except instead of clues at a crime scene, we're looking for those undervalued gems hiding in plain sight.
Exactly. Now, Graham's not saying growth doesn't matter. It absolutely does. It's about paying a sensible price for that growth, a price that reflects the company's earnings, its assets, its realistic potential.
Not getting caught up in the hype, paying extra just because everyone's talking about it.
Right. And watch out for unnecessary complexity. If a company's financials are a tangled mess or their business model is hard to grasp, that's a warning sign. Look for transparency, a clear track record of profitability.
Basically, focus on what really matters. Can this company make money consistently over the long term?
That's it. Strip away the distractions, the flashy stories, and that's what you're left with. Now, a key theme that runs through all these comparisons is the importance of contrarian thinking. The market, it often gets things wrong. It's driven by emotions, narratives, not always by the facts.
So we got to be willing to disagree with the crowd, to see those opportunities that everyone else is missing, and to have the guts to, actually buy when others are selling.
That takes courage and a whole lot of patience and discipline. Value investing, it's not about getting rich quick. It's a slow and steady approach focused on building wealth over time.
Writing out the ups and downs, trusting your research, and believing in the companies you own.
Exactly. Now, another crucial concept that Graham highlights is the margin of safety. It's about buying stocks at a price that's significantly below their intrinsic value.
So you've got this cushion, this buffer against mistakes or unexpected events.
Precisely. That margin of safety can come from a strong balance sheet, consistent earnings, or simply a market price that's just too good to pass up.
Got to be ready to pounce when those opportunities arise.
And remember, investing is a lifelong learning process. The market's constantly changing, so you have to adapt and evolve.
Stay curious, question everything, keep refining your approach.
Graham himself said it best, the investor's chief problem and even his worst enemy is likely to be himself. Manage those emotions. Don't let greed or fear take over, and stick to your principles.
Wise words. Well, this deep dive into Graham's world has been eye-opening, to say the least. We've learned about market psychology, the core principles of value investing, and the power of independent thinking.
It's been a pleasure exploring these concepts with you. Remember, never stop learning, never stop questioning, and never stop looking for those hidden gems.
That's what we're all about. Thanks for joining us for this deep dive. Happy investing, everyone.